Tell me a pretty quick story on when things went really well. Like, as far as somebody came to you and the whole process was just pristine. What comes to mind there?
So what comes to mind is somebody that is prepared from the get-go. I tell them what
So they
what
listen
need
to this podcast.
Yeah, they listen to this
Bring their
podcast. Right.
Rule of twos.
Yeah, they brought the rule of twos. And then also they listen to the advice, but they are punctual in getting me documentation.
All right, so we're going to jump in. Welcome to the show, and we're excited that you're here. Thanks for your time. We're going to continue on with Real Estate Month. So we're talking all things real estate. So this is not Josh. This is Steve Cook, and he's going to be helping us understand the lending side of real estate. So he's a mortgage lender. He's been in the business for 17 years. He's been doing it for a while, but I actually know Steve apart from just the lending side of things, and really brought him in just because I trust him emphatically. He's a great man, great human being. So that's why you're here.
Thanks, Brandon. Thanks for the warm introduction.
Yeah, and we've had conversations about what we're going to talk about today. The premise, the whole point of everything that we're doing on this podcast is education. So in the discovery of who should be buying, when should we be buying, we talked on the previous podcast about our non-negotiables from a financial advising standpoint. What should we be telling our clients, or what should our clients be expecting to hear from us as far as when to buy and when not to buy?
Sure.
We start there, but once the decision's made, we might need to talk to a lender, right? So I kind of went back and forth whether to start with a real estate agent
because you probably
first.
don't favor cash purchases, right?
Yeah, I mean, I would. It just depends on the circumstance for sure. But yeah, if somebody needs to
There are
buy a house,
percentages, right?
yeah, we're looking at the cash flows for sure. But I would say, I think, I started out or when I started thinking about how to maneuver through the month of July, talking all things real estate, I almost went to a real estate agent first. Mm-hmm. And I didn't. And my logic behind that was, I feel like the game has changed. So a decade ago, if I wanted to start shopping for a house, I'd probably find a real estate agent. The problem now is, even if I do that first, the first thing a real estate agent is going to tell me to do is go find a lender and get a pre-approval.
Right.
All right. So that's really why we're starting here, is because I think with a fast-paced market, the best place to start is with the lender.
Yeah.
Even before you start searching for houses, if you have the thought of, I might want to buy a house, talk to me. If you're working with me, talk to your financial planner if you're working with a financial planner. But the next step should be finding a lender.
Yeah.
So
the landscape really has changed in that. I mean, years ago, somebody couldn't even find out the details about a house unless they spoke to a realtor and saw the NMLS, listing, or MLS listing. And NMLS is National Mortgage Licensing.
Oh, gotcha.
Sorry. But now there's so many different websites that people can go to and look up information on a home. And then as soon as they see the pictures that they like, the price point that they like, their next question is, what's my monthly payment going to be? And
right.
So they start calling lenders, and now lenders are really saying, are you working with a real estate agent? Before they go to a real estate agent, and the realtor says, are you working with a lender? Yeah. So the tables have definitely changed.
It's definitely an ecosystem. So if I want to buy a house, or if I'm thinking about buying a house, at what point should I come find a lender? At what point should I go approach a lender and say, hey, I'm thinking about this?
As soon as that thought enters your ear,
Yeah.
That's when you come speak to a lender. Just like I was mentioning to you before in our conversation, like people don't come to you, Brandon, and say, "Hey, I want to retire today."
They actually do say that a lot.
Right. But that's not the best strategy for most of us, right?
Definitely not.
If
Definitely
we don't,
not a good strategy.
yeah. And the reason I say very early on is because let's say somebody doesn't qualify today. We need to have a strategic plan in place to get them to qualify. So if they're saving up the 20% down that you recommend, how far away are we? And can you and I get together and say, okay, Brandon, how long is it going to be for them to save up for 20%? Or can they pull from here or there to have that 20%? And then how would that affect their overall financial picture?
Sure.
Right.
So let me ask you this. Top of mind, like top 3 things that would keep me from getting qualified to purchase a home when I come meet you. What's most common that you see?
So what's most common is qualifying income.
Okay.
Somebody
Talk to me about that. What's that mean?
who maybe they worked for an employer, they're a W-2 employee, right? And then they go out on their own, and now they own their own business, but they're self-employed, and they've been doing it for 6 months. They're, just gas pedals, full force, and they're just, knocking it out of the park. And they think, hey, I'm going to buy a house now because I have all of this. Well, that 6 months of self-employment is not qualifiable, right?
Yeah.
So we generally need 2 years, right? But
And not just
minimum
2 years. Typically, it's 2 tax returns, right? Like typically,
Yes.
you want to see that proof on the tax return,
Right.
Because for example, for me, started my business in January, and well, we file an extension for our taxes, so it'll probably be the better part of like almost 3 years,
Yeah.
before I have the right documents to bring.
So
to
there are exceptions to
Sure.
that. Like if somebody gets out of college and they start their own business, we can do 1 year of tax returns. Or let's say it's 18 months or almost 2 years and the income's good enough, then we can just average that over 24 months.
Gotcha. That makes sense.
So their monthly income would come down, right? But we could still get them qualified.
That makes sense. So what should I make sure, like if I was coming to see you, right, thought enters my head, I'm thinking about a house, I need to come see you, what should I bring to the table when I come?
Yeah, so you're thinking, hey, I want to be a homeowner. I'm going to go meet with Steve Cook at Loan Depot. Little shameless plug there. We would typically want to see 2 years tax returns, 2 years W-2s, 2 most recent pay stubs, and 2 months of bank statements. I call it the rule of 2, 2 of everything.
Makes sense.
We're probably not going to use the tax returns. Like if you're W-2'd, you've been on the job for, 3-4 years, we're typically not going to use the tax returns. One reason why I like to see the tax returns is what else is there in the tax returns that might make me change my recommendation or my strategy for towards a loan, right? So if I see that maybe there's an alimony payment or something, right? Well, their W-2, I can go up to certain percentage, right, of their gross income. But if I go too high, I know that they also have this other expense that I'm really not taking into consideration. So I want to make sure that I put my client in a good buying
So
position.
the tax return tells kind of the more complete story.
Right.
It shows you
Right.
more full
But
picture
it's
than
not
just
necessary.
a W-2. Sure.
It's just how deep do you want to dive?
Yep. And that's what I mean to like again, just pointing out one of our non-negotiables here for clients at Harp with Wealth is we're wanting you to stay well below, but the maximum your mortgage payment should ever be, your principal, interest, taxes, and insurance, that pity payment should never exceed 28%. So to your point, yeah, being able, like if you just look at my W-2 and you see my gross
Right.
income, that might, you can be like, oh, well, this fits within that 28% range that Brandon wants his clients to be a part of. But we also don't want to exceed 36% of total debt payments. And then all of a sudden you look at that alimony and you're like, man, that's a lot of income coming off.
Yeah.
So yeah, I think that's brilliant that you guys you take that into consideration.
Another thing also is if I see interest, on their tax returns, or if I don't see interest, that tells me, they don't have any other buckets complete in their financial portfolio. Maybe instead of going really high in their mortgage payment, maybe we should bring that down and give them a little bit more cash to invest and
Gotcha.
and make
so
other.
that might be a decision between like a 15 and 30-year loan.
Yeah.
Yeah,
Yep.
that makes sense. That's great. I think that, one of the things we were talking about earlier, you mentioned the term recast. And I thought that was because I'd never heard that before. So definitely want to revisit that because I think that was interesting. And the reason why I think it's interesting is because I have clients come to me all the time, and I've had clients receive sizable inheritances.
Sure.
But I've also, like, the most common is they receive an inheritance from, a grandparent, and it's sizable, but it's not significant. It's not life changing, right? So maybe they get, $50,000 from their grandpa, and if that's the case, it's very sizable. It's a great sacrifice. Somebody, it's a act of generosity, but it's not necessarily. It doesn't mean that I can retire 5 years earlier, right?
Sure.
So in that case, the question becomes, what do I do with it? Well, explain recasting, because I think there's a lot of times an assumption that if I want to reduce my mortgage payment,
They're going to have to refinance.
that I would have to completely refinance my loan.
Right.
So we're in an environment right now where rates 3 months ago were like a third, at least a half of what they are now, right? And so if I were to, let's say, bring $50,000 to the table and I have a 3% interest rate,
Right.
well, now do I have to refinance and put that $50,000 in and get a 6% interest rate?
Yeah. No, you don't have to do that. A lot of people, that prevents them from refinancing is they'll say, okay, I bought my house last year and I got 3.5%. Rates now are at 6. I have all this money. I would really like to lower my mortgage payment. Well, one thing that you can do is you can keep the 3.5%. A recast is a sizable down payment on your loan, and what the only two areas that change are your principal balance. So it's a principal balance reduction, and then they recast that principal balance reduction amount to the remaining years on the loan. So if you've been in a loan for 2 years and you only have 28 years left,
I'll still have 28 years.
You'd still have 28 years, and they divide or multiply the interest rate against that reduced principal balance, and then divide it over 28 years instead of 30.
Yeah, and so that could also could be a similar process for reducing or getting rid of PMI.
Sure.
What about if, like, there's a lot of people around here, I know a lot of my clients are renovating their house. So what happens if I renovate my house and get a new appraisal and my $500,000 home is now a $600,000 home? Could that be part of a recast as well? or is that something completely different?
That's something completely different because we also have renovation loans. Renovations loans are a great product. You can basically take a house down to the studs and include the cost of the renovation in your loan. So you do a prior appraisal, and then you have a project coordinator or construction guy come in, and he says, okay, we're going to add $75,000 onto this $230,000 house. Now your new appraised value is $305,000, right?
Yeah. So, but if I just had a conventional loan, let's say I've been living in my house for, 3 years, and I decide to add on a new bedroom, and so my $450,000 home's now worth $500,000, and otherwise I'm still paying PMI. Would I just be kind of forced to refinance at that point, or do some sort of?
No, because what you can do is you can notify the lender as long as it's been 12 months.
Mm-hmm.
You notify the lender. You pay for a new appraisal, and you can ask for the mortgage insurance to be removed if it's a conventional loan.
Yeah.
Now, an FHA loan, the mortgage insurance is for the life of the loan.
Yeah.
And so that was, I say, a recent change because it was within like the last, 5 years or so that FHA changed to the life of the loan rather than just to 78%.
Gotcha. So help me understand. Let me ask you this. Let's say I'm looking for a loan. Now, I'm a veteran. I'm pretty comfortable with risk. So in terms of like if you were to try to like talk, I think I don't know. Do you guys do like any kind of risk analysis with people you're working with to understand like adjustable rate mortgages versus fixed? Is there any considerations there? So if I'm a veteran, if I have an appetite for risk where I know that I can tolerate the doom and gloom of a 7-year adjustable rate, help me how do you help me choose what loan is right for me?
So what I do, Brandon, is I do a side-by-side comparison. So I'll sometimes do 4 loans side by side. Sometimes I did a video explanation also. I've added that. That's post-COVID. I had a lot of time during the pandemic, and so you get the camera and you get the tools and everything, which you have here, and now all of my loan estimates and loan comparisons are attached with a video link that they can watch it. So that allows me to actually do more than 4 loan comparisons because now they're just tabs on my computer and I share the screen. So I would show you at each year where the difference is in equity, right? So if a 5-year ARM is going to, the interest rate, let's say it's 2% less than the conventional fixed rate, then we show you how much you've paid in interest in a year. We show you where the equity is, and then it really becomes up to you where your risk tolerances are. I don't think the ARMs are there yet.
And you would probably say something like, "Hey, you should take these 4 comparisons to your financial planner." And
yep.
I'm just kidding. And I just want to stop real quick.
I do.
And acknowledge something. We record this live in my office in downtown Franklin, and we are not in a sound studio, and we don't do a lot of editing to this stuff. It is storming outside pretty violently. So if you are listening and you hear the soft rumble of thunder, I thought
that was somebody coming up the stairs or something.
It is what sometimes there's honks from the street. So it's just part of it. One day we might have some crazy professional studio, but not today. So you really put the owners, there's a process where you do a lot of analysis. You see what I can bring. So at this point, you reviewed my W-2s, you reviewed my tax return. You're looking for all these kind of potential holes in my total financial picture.
Yep.
You probably you do a great job of making sure, like, you send people to me all the time saying, hey, you should go talk to this person, just so if they can make sure they can't see anything.
They're making the largest financial decision of their life, unless they own a sports team or something, right? But I mean, a mortgage, you're buying a house, you're talking about hundreds of thousands of dollars. And we talked about recast, but usually there's one time, right, where you're going to decide how much you're going to put down, what type of loan you're going to want. So I'll always advise people, there's no right or wrong answer here, right? You may choose something that is more conservative than the person I talked to you yesterday, or more aggressive than the person I'm going to talk to tomorrow. So there's no right or wrong answer. There's just the right answer for you, right? Because your investment preferences are going to be different. Your tolerances are going to be different, than other clients. So it's going to be the right answer if it's an informed decision.
Absolutely.
So and talk to your CPA, talk to your financial planner.
Not just like when we talk about like the largest financial decision purchase of their life, it's also a huge commitment. I mean,
sure,
theoretically, you're probably going to live in your home potentially longer than you'll live with your children, right? Like most, hopefully, we love our kids, but we want them gone one day.
We want to raise them right and set them out.
Get out
of the nest.
But yeah,
fly on your
theoretically, you're like, and we were just talking about this too. I make sure that when I'm talking to a client about purchasing a home, they understand, like, my view on signing a contract is you're going, like, as a base case, you're going to fulfill the terms of that contract. And so, yes, many people move multiple times in their life. Many people buy and sell, and they don't settle. They might own 3 different homes in a lifetime.
Sure.
But the base case should be that when I put my ink on this paper, if I'm agreeing to 15 years or 30 years at X percent, my mortgage payment's going to be this, the home that I'm buying, that's what I'm agreeing to today. I'm agreeing to owning this home and paying this mortgage for the next, potentially 30 years.
So you better be
life.
able to afford it.
So it is. Yeah. It's a long-term commitment. You need to think it through. And I just think that's super important. And I think you do a great job of making sure that people understand their options. And you do a good job from your seat of looking at their entire picture, which is when we leverage our tool, our financial planning app, that, like, part of this education process that we're working through, we really want people to understand all 12 of these financial vital signs. And I mean, the vital signs we're trying to make it very simple to understand, but it's cash flows, it's net worth, it's all these really complex things that people are like, oh, what's he saying? What we're saying is just know the whole picture, know what you're getting into. And you do a good job of that.
And I do it. That's a part of my approach, my own personal approach, because not only is talking to Brandon smart to do before you buy your house, but I can't even count the number of times where my loan pretty much looked like another lender's loan, but the people went with me because I gave them options and I gave them advice to talk to somebody, and they just told me, Steve, we're going to go with you because we trust you, right? So yes, I know it's right, but it's also smart for me professionally to give that level of service, because I know that I'm going to win that many more deals as well.
Yeah, and I think that's huge. So your process, you're educating me, you're doing the analysis, you're presenting me with options, you're allowing me to pick the option that's best for me. So I think one of the things that I focus on when I work with clients individually is building trust. I think trust fosters so many different important pieces of confidence, overall the feeling of, if you feel confident, if you feel like you can trust the process, then you're going to have a feeling of success. So there's so much there. And what you don't want is you don't want a process to be rushed. You don't want holes to not be overlooked, because then they're coming to closing day and they're anxious, they're uncertain, they're concerned.
And they've had a bad experience.
And they're making some huge commitment, huge decision that should be one of the happiest days of their life.
Right.
And instead it's stressful and they're having second doubts. So, I think that the process is important, and I think you do a great job there. Should I shop around? Should I talk to different lenders? Is there a chance that I'll pay too much for a loan if I don't go to, 2, 3, 4 different lenders, or different types of lenders too?
Yeah. Shopping around, no. Good. Steve Cook at Loan Depot. I would probably limit it to 3 lenders. There might be a lender that maybe has a portfolio product, for example, like the doctor loan, where you get a special interest rate, no mortgage insurance, borrow over 80%, right? And there's a few lenders in town that can do that, right? Or perhaps there's, I'm trying to think of another reason to shop. I think it can also build confidence too. So if I tell somebody, hey, these are your 3 or 4 options here, and then they talk to another lender and they only give them one option, and maybe it's like a cookie cutter deal or something, it gives them more confidence in my presentation to them that they've talked to another lender, and they were not at all as thorough as Steve was in his presentation of options. But I also think that it puts the home buyer in the driver's seat of I made a choice on my loan rather than I was sold on a loan.
Gotcha.
So, maybe 2 lenders, 3 at the most.
Is there a chance that, like, other than special programs at special places, I try to stay aware of those things for my clients, because if I do have a client that is, in a unique circumstance or in a unique career field, just right. having those kinds of options do matter. Yep. But apart from that, is there a chance that if I come and sit with you, like what is there a chance that I'm leaving money on the table? Because I know that I've talked to lenders in the past. They're like, oh, we'll scratch this cost, or this cost is $450 instead of $800.
Right.
Is that important? Should I watch for those things? Are there costs that, like, is there a way to know that I'm paying too much versus know that I'm getting a solid value for?
Yeah, I think Dodd-Frank, that law that, back in 2009, I think it got rid of a lot of the bait and switch. Unfortunately, not all of it. I mean, I still see it. But as far as cost, most of the costs on a loan estimate are not controlled by the mortgage company. Most of the costs are all controlled by the escrow company or the title company that's going to close that loan. Like Loan Depot, we have 2 charges: underwriting and processing. That's it. And so there's not a lot of frivolous fees anymore on the lending side. I caution people to look at, if they're comparing 2 loan estimates and one has really reduced fees and the other one, let's say one, the fees are a lot lower, you're probably going to get a different picture at the closing table, because some lenders, I'll see this now, that they'll say, oh, well, we don't control those fees. Just like I said, Loan Depot has 2 fees. All of the rest are controlled by the title company. Some lenders will use that as an excuse. Well, I didn't know what their fees were,
so
right?
Put it in there.
So title fees are $1,000. No, actually they're $2,500. You know, and the title company is going to correct it, but
That makes sense.
then they'll get the appraisal deposit, they'll get the commitment, they'll lock the rate, and then the people are committed, and then they get a different sales call saying, "Oh, well, hey, we just got the adjusted title fees."
Yeah.
You knew those title fees. Come on.
Yeah, and I think that's. I tell people that I have,
That's where I
obviously-
caution it. Yeah.
Obviously, being a financial planner, like we have conversation about fees and cost, and I've really come to learn that I don't think people necessarily care about your fees. They just want to understand them and know what they are and make the decision and not be tricked into them.
Yeah. That's why I did the video
totally
link.
get it. Like I completely understand. I would be so upset, if I came to the table thinking all these things and then I'm, excited and nervous and all these things and everything's moving fast and it's just paper after paper and I'm signing, and then come to find out I paid almost triple from the fee that you quoted me.
Yeah.
That would make me angry. Yeah. And in the grand scheme of things, it probably doesn't change much, but you deceived me, so you could close the deal versus me going with this other person.
Yeah, and
so it's upsetting.
In a loan estimate, there are zero tolerance fees, and then there's a 10% tolerance fees. So they can't bait and switch you too much now.
Yeah, that makes sense.
But fees that you can shop for, that's title fees, right? Origination and processing and underwriting, those are not fees that they can shop for. I mean, yeah, they can shop other lenders, right? Mm-hmm. But like, if I tell somebody that their processing and underwriting fee is $1,500, I can't change it 2 weeks later and say, well, no, it's actually really $2,000. That's zero tolerance.
Are there any variances other apart from cost? Are there variances in, say, like I heard somebody that I was speaking with, they touted that their place of employment, I don't remember what company it was, but offered like an extended rate lock, where they guaranteed a rate for a longer amount of time than anyone else. Is that matter of fact? Like, is that something that certain people can offer? I would think that it would be pretty.
Yeah, that's
similar.
That's actually a differentiating factor between lenders. So I think really lenders differentiate themselves based on service, but I include the extended rate lock in that service. So like Loan Depot, we have really good extended lock programs, but I also think it's even more important who you do the extended lock with, because most extended locks are going to give you a float down closer towards closing. So if you're buying new construction and it's 6 months away and you do a 6-month lock, well, 45 days prior to completion, you're allowed to float down that rate to the current market. Well, who do you want floating your rate down to the current market, right? So there are some times when I'll advise somebody, yeah, we're not going to, I know it looks better now, but we're going to wait 3 or 4 days because the jobs report is coming out.
Gotcha.
And all indicators are saying that that's going to be good for mortgage rates. So maybe when I float them down, maybe I get them 1/8 of a percentage less than.
And to be clear, when you say good for mortgage rates, it's like golf, right?
Right.
Lower is good.
Yeah.
Not like
good.
my job. Right. Lower is not good for me most of the time. And then
by the way,
I think
Brandon's golf score is lower than mine. So.
I think one of the other differentiators, right, was that I wanted to bring up, because I've heard this before, but I don't completely understand it, is like a guaranteed to close on time. Have you seen or heard anything like that?
Yeah, that's kind of a funny question, because I was told when I first got into this business, I was told by a realtor, if you don't close on time, like, lose my business card, like, never call me again. So I have yet to not close on time due to my fault.
Your own fault, right?
Sometimes the loan doesn't close on time because the borrower suddenly has to be out of town or something, right?
Or they go purchase like a brand new car 10 days before. Yeah.
Right.
Yeah, makes sense.
But yeah, closing on time that shouldn't be like a banner ad on their website, right? That should be a given, right? That should be like you talk about at Harpeth Wealth. That should be a non-negotiable.
Yeah.
You know. So I had a phone call this morning with a realtor, and she asked me about a 45-day close and a 30-day close, and then as a strategy to get her clients this house, she asked me, like, how quickly would you be able to close? Like, could I make my offer more attractive if we're making it today, it's July 7th, would you be able to close not on August 7th, but what about the end of July? And so once you have that dialogue and it's clear, then sometimes I'll say, no, I can't close in 10 days.
Yeah.
Right. But I told her this morning, yeah, we can close by July 30th. And it also depends on the file. So do you have some credit repair to do?
Sure.
Does somebody own like 3 or 4 businesses, and you have to look at all of these corporate tax returns, and is it a complicated file? Well, then that might be a longer closing time frame. But I would say for the average home buyer out there, closing on time, 30 days.
So one question. So it's 2-part question. Kind of opposite. Tell me a pretty quick story on when things went really well. Like, as far as somebody came to you and the whole process was just pristine. What comes to mind there?
So what comes to mind is somebody that is prepared from the get-go. I tell them what
so they
what
listen
they need
to this podcast.
Yeah, they listen to this podcast. Right.
Rule of twos.
Yeah, they brought the rule of twos. And then also they listen to the advice, but they are punctual in getting me documentation. We may need, for example, today it's really common for the underwriter to request a letter from the employer that states that the person works remote 100% of the time, because otherwise the employer's address is in, Detroit, Michigan, and the underwriter says, hey, you can't travel between Detroit and Nashville, and have it not cost you anything, right? So they get a letter of working remotely, and they just get you everything that you need on time, and they work with you. That is an absolute pleasant experience. The second part of your question, which I'll anticipate, what's a bad experience?
Yeah, tell me a disastrous time.
Is somebody that isn't prepared, and then they argue every step of the way that the underwriter shouldn't need this. The underwriter shouldn't need that I work remote. I told you that I do. Look at my tax returns for the last 2 years. They've been mailed here. That means I'm working out of my house. I'm like, in the 5 minutes we've been having this conversation, you could have gotten that letter that says you work remote. But somebody who basically tries to underwrite their loan. Trust the process. Listen to the podcast. Right?
Yeah. So I have a disaster story on the house that I was going to try to buy, which I won't get into. We'll talk about that a little bit more offline. But I was at the closing table, ready to sign, and I was good. I was prepared. Everything was well. The title attorney actually came in and was like, Brandon, I need to talk to you. And he was like, hey, this isn't really my lane. He was like, I was just looking over this right before, just, make sure everything was good from our end. And he's like, I noticed this one little thing. He's like, do you know about this? I was like, no. He's like, I would never buy this house in a million years.
What was it?
I'll tell you offline. Oh. But it was, he saved my life, really. I mean, he saved my livelihood. I would have bought an absolute disaster. So things can go wrong, and you just need a good team. I think that's really, really
Right.
important.
You need to trust the team. The term that you said, like, this is not my lane, but trust the individuals that are in that lane. Trust your realtor. Don't think that you know more than your realtor. Don't think that you know more than your mortgage person. Don't think that you know more than your financial planner or your CPA that's telling you to do this or do that. You have relationships with those people for a reason. Trust the process, and it should be a good.
But I will
experience.
say this: non-negotiable number one. So we're going to recap these two real quick because we're about to wrap up. The non-negotiable one is do due diligence.
Yes.
Right. So we're not completely abandoning appraisal processes. We're not completely abandoning inspections, and we should go and get a couple quotes, right? Or talk at least interview one or two mortgage lenders, at least interview one or two real estate agents, and even financial planners. I don't want somebody coming and working with me that hasn't even thought to consider some other option in some other way. I want them to have some comparative baseline. And so if you've never worked with a financial planner and you and I are having a conversation, it's the very first time. 9 times out of 10, I'm going to tell you, one, here's a list of questions you better ask me, but also call somebody else and ask them these questions too.
Right.
Have some grounds of comparison so you have a little bit of confidence. Do due diligence, non-negotiable number one. Number two, just to recap from the last call, you got to know your healthy debt targets, right? So 28% for pity of gross income. Total debt should not exceed 36%. These are what Harpeth Wealth Partners, what we consider healthy. If you're in our program, our Vital Signs Planning and Education program, and you have the app, these things are measured, and we're doing a call. We're doing 2 calls this month, 2 private calls that will discuss more in depth about those things, to how to figure those things out. But it's not hard math. You're just taking your gross income and dividing your payment or dividing your total debt payments.
And those ratios also lead to a loan approval.
If you're meeting my guidelines, you are going to be able to get approved, at least from debt levels. You got to know your whole. So non-negotiable number 3, know all of your financial vital signs. You should, again, it's kind of plays with that due diligence, right?
Yeah.
If I know all 12 of my financial vital signs, and I know that they're healthy, and I've considered my whole ecosystem, my financial ecosystem, I'm going to be prepared. I know that I have confidence I'm making a good decision, and I'll show up to signing day happy, right?
Right.
Non-negotiable number 4,
experience.
5 to 7 years, right? And we talked a little bit about this before we jumped on here about, what happened, because we were talking about, 20% down. So I, as a financial planner, give grace to people buying their first primary residence.
Sure.
So you don't have to have 20% down if it is your first purchase on your primary residence. So
because of the cost of waiting analysis you could do.
Yeah,
right.
We can talk about that. I think that the important thing is but every subsequent purchase should be 20% down. Now, you showed me a comparison where it's like, okay, that makes sense, but that would be very individual. Right. That would be a very individual circumstance, and that would be like, hey, show this to your financial planner. You come to me and be like, actually, that's a great. Yeah. You showed me something that was great, and I would have told that client, hey,
it is like a niche kind of category.
It is,
it's like
but
high credit score, high income.
But the thing is what we were talking about was like, let's imagine I live in kind of like a middle of nowhere town in, let's say, Nebraska. And I'm moving into a Brentwood or Franklin, Tennessee, where houses are it's expensive to live here, right? To buy a property in Franklin, it's a sizable purchase. What happens if I sell my house in middle of nowhere, USA, and I'm moving into town and I don't have 20% down? My question is, why are you moving right now? Why are you moving here? Well, it's for a job. Okay. Why are you buying a home if your job is making you move so much? Well, they're not. It's just this one time. Mm-hmm. Well, are you sure you can be here 5 to 7 years? So one of our non-negotiables is making sure that you can be in the house that you're buying for 5 to 7 years. because you just need that. If you're going to be in a situation less than 5 to 7 years, consider renting. And it's okay to rent for short amounts of time. Not everybody needs to be a home buyer, a home owner all the time, right? Renting exists for other circumstances, and it's not always a bad decision.
And your reason for 5 to 7 years, Brandon, is probably
appreciation,
length
pay
of
time
time to
like it gives
ride
me
out any volatility.
It gives me time to pay down. So if I put, let's pretend this is my first time home purchase, and I'm a veteran, so I can put $0 down. So I'm putting $0 down. I'm buying a $500,000 home. We're in a unique situation right now where I could buy a home, pay closing costs, pay realtor fees, and probably in the next 2 or 3 months sell it
and make money.
That's not normal.
Right.
Normally, my house ebbs and flows. If I check Zillow every day, I will see my home value change, and sometimes it goes up and sometimes it'll go down. It is not normal to have these straight line trajectories that we've been having. So you need to be prepared to be upside down. It's not the end of the world as long as you know, hey, I plan to stay here for 5 to 7 years. And the only time it becomes an issue is, let's say I didn't put 20% down and my home value does come down and I get laid off from my job, or my job's like, hey, if you don't move to this new location, you can't work here anymore. So I'm without income, and now I can't afford my mortgage. Now I'm upside down in a house and I can't afford it. I'm stuck and I'm in a real bad situation. So that's what we're trying to prevent. If I know that I have some longevity, if I have my emergency savings reserves for 6 to 12 months of living costs, I'm going to be okay. So that's important to understand. And then the last non-negotiable is kind of thinking through that last piece we just talked about. Think through worst case scenarios. And when I say worst case, I always mean realistic worst case, right? So we talked about down payments, especially for first time home buyers. Maybe I have 15% saved up, and you're saying, hey, if you do it this way, we could actually get you into a house and you could pay 5% down. And then you'll have this really small one-time PMI fee. So it's one and done. It's really it's going to be really small if you stay there for 5 to 7 years. This is a good deal. This is a good plan. Plus now you have this extra, $10,000, $20,000 to bolster your emergency savings account, because what happens almost every time somebody moves into a home that they just bought, something breaks. Yeah. Right? You got to buy, you got to replace, you got to, fix some electricity issues. You got to put a roof patch in, or whatever the case may be. So it gives me
unless
some
they buy
cash
new
flows.
Construction,
which maybe at least the warranty will cover, because I've seen disasters.
It's interesting that you talk about worst case scenarios, because that's another area that I'll cover on the loan application with somebody, is especially with like joint income. Mm-hmm. First, newly married, right? And I'll ask them. I think it's about having those honest conversations with people. How comfortable are you asking those questions and getting those answers? Because I'll say, okay, so you guys just got married, plans to start a family. What happens when her income goes down? Right? You're pushing these debt to income ratios, right? You might be headed for a single income tax return, in the next couple of years, right?
And to that point too,
to consider worst case scenarios.
When I say worst case scenarios, I say worst as in it changes the fundamental assumptions of my decision or plan.
Right.
Sometimes these worst case scenarios aren't bad. So what happens if I'm buying a house that's a 2-bedroom house? I want to buy today, and my spouse and I are trying to have children, and a month into this new home purchase, we find out we're having triplets. And so now, instead of needing a 2-bedroom house, I need a 4-bedroom house. Within surely in 7 years, having 3 kids in 1 bedroom is going to probably not be great. So maybe, if I'm trying to grow a family, is there a chance? So it doesn't necessarily, a worst case scenario is not necessarily all bad things. It can be good things, like a growing family. If I want to grow my family, that could be good. We're going to wrap up. I want to ask you this. Give me one takeaway, one golden nugget that you need me to hear and leave with.
Well, I would say, listen to the podcast. Trust your instincts, but also trust the advice, because you want to, a phrase that I will talk with my clients with is, I want to put you in the best buying position so that you can have the best buying experience, right? And that experience really is important. And so when you are prepared, when you do listen to advice, when you all have, as they say in Tennessee, all of your ducks in a row, right? Then you are going to have a good buying experience. And maybe your buying experience isn't today. Maybe we put all of our ducks in a row. They spoke to you, they spoke to me, they spoke to their realtor, and maybe their best buying experience is 6 months from now, right? When they can more realistically afford it, or something. So, yeah.
Well, I appreciate your time. Buying a home is exciting when we want to do it. It's a huge financial commitment. It's one of the biggest financial purchases that we'll make in our lifetime. Fast forward towards, typical retirement age, mid 60s or so, most people have an incredible amount of equity in this asset. So it becomes a very big piece of net worth, of their net worth statement, or their net worth of their assets.
Sure. It can be wealth
building. It can be a huge representation of your wealth. And with that, it puts so many things. There's studies to show that people that own their house, there's like this perception of financial success that is like unmatched in any other realm when it comes to home ownership. One other really unique thing was it did not matter how much the home was worth, only that they owned the home.
Right.
So according to this study, owning a $200,000 home produced the same amount of feeling of success as did the person that owned a $2 million home outright, right?
Yeah.
So just, this notion of owning a home creates this feeling of success. We want our clients to be successful. We want people to be successful. I don't care if you work with me or work with someone else or work with no one. I want you to be financially successful, feel financially healthy. I think that's
how I got
super
into the
important.
business, was buying my first house.
And
I felt so great about it that I didn't want
to do it for everyone.
I didn't want to finance commercials anymore with an advertising company. So people will go to the kitchen. They're not even watching the commercials that I helped finance. And I thought, hey, I'm going to get into home finance, right?
That works.
Yeah.
The thing is we definitely want people to understand this process. I think one of my big things that I would convey is, if you are working with a financial planner, definitely talk about this. You want to make sure you consider all these factors from a financial health thing. But I'm not a mortgage agent, right? Like I need to rely on mortgage experts. So sending my clients to you or to anyone that they might know to say, hey, how do I get into this home the best way, the right way? What are my options? Having that presented, making good decisions, that's all part of the process. I would definitely start the home buying process by talking to a lender before an agent, real estate agent. And then I would also say that, to your point from earlier, start early. Do not wait until it's time to buy. Start talking. If you never talk to a mortgage expert and you think, hey, there's a chance that I could buy in the future, talk sooner than later about that. Because it doesn't do anything to talk too soon, like to get educated.
Right. Talk to a lender first, because you might be, visiting the wrong neighborhoods. You might be visiting neighborhoods and looking at houses that you can't afford.
Yeah.
And then that also plays into what's your buying experience. Now that you spoke to a lender, now you're looking at this different neighborhood and you're comparing it to the $1 million homes that you're looking at, and you're just not going to be happy. But if you speak to a lender first and you know what your monthly budget is, how you can cash flow, where your debt to income ratios are, all of your non-negotiables, then you go to that same neighborhood, but it's the first neighborhood you look at, you're going to have a better experience. You're going to feel better about it because it's the right approach from the beginning.
We're using our planning tool to help people understand all these financial vital signs. We're making it really smooth, really understandable. I think everybody should have access to this. We've made it very accessible, very affordable. So you don't have to work with me one-on-one to be in this planning ecosystem. You still get access to the private calls and all that stuff. You get the app, and you get some one-on-one coaching as well. If you want to know more about that, send an email to us. You can get on our website, hit us up on socials, whatever you need. We definitely look forward to that. This is a longer podcast, so we're going to cut it off. Thanks, Steve, for your time.
Yeah, and, thanks for having me.
Yeah, we'll talk to you guys in about a week. Take care.
We hope you learned from our conversation today. It is important to us that you know this is for educational purposes and not intended to be considered specific advice for any individual listener. If something we discussed is relevant to you and you have questions of how it might be applicable to your specific situation, please reach out to your financial professional. Of course, we are happy to have further conversations with you regarding specific questions or applications to your individual financial situation. With that, here are a few disclosures. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Harpeth Wealth Partners are separate entities from LPL Financial. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hypothetical examples presented are not representative of any specific investments. Your results may vary. With that, thank you, and we look forward to having you back. Take care.